Sitting here with Ken Assiran. He's the managing principal of Capital Health Group. And Ken, you started off 2014 with a bang with the announcement of a $96.6 million acquisition of 8 properties out west. What did you like about this portfolio?
I thought it was a great portfolio. You know, the buildings were in good shape. There was a great corporate culture there, and it was a great opportunity for us to buy enough mass to open a new region in the West.
So that is a new region for you, because I don't think of you as going that far out.
Yes, it is a new region for us, where we're very interested in getting a foothold in the West, and this portfolio is providing that opportunity.
So was that part of a strategic decision with your growth plan to expand geographically? Was that?
Yes, I think our growth plan is to expand into new regions where we can buy enough critical mass and to enhance our existing regions.
And do you have any plans to do anything at these communities? It was 8 of them, correct?
Well, there's actually 9 buildings but there's 8
campuses.
8 campuses.
Right.
Yeah, we'll work with the buildings. The buildings are in good shape, but we'll enhance them. We'll do some renovations in the building. We want to provide our customers with the best possible physical plant that we can. So we'll do some enhancements to the buildings, but basically the buildings are good. There's a good culture at the buildings.
Because they're about an average of 10 years old, right? So they're in pretty good shape. Is there anything specific you're going to be doing?
Yes. Overall we'll be enhancing services and programming. But in order to do that, we'll be adding to the level of care. We'll be adding programming, and we'll be adding to the continuum of care.
Right.
The buildings that were assisted living and didn't have dementia care, in some cases we're adding dementia care, and in one case we're building a new dementia care or memory care building.
Which seems to be the thing to do these days. Everyone's doing dementia care, which obviously is an important need. You and your partners put a lot of equity into the transaction, almost half the deal price. Was that an important consideration in terms of getting the transaction done from the seller's perspective?
Well, no, I don't think it was really the seller that was driving that. I think we always invest carefully in whatever we do, and I think with our partner AEW in this transaction, we basically decided to put a reasonable amount of leverage on the deals, and we basically assumed the existing debt in all cases in Utah, and so the Nevada transaction, we bought all equity. So I think that skewed the ratio a little bit.
Because all the properties were in Utah, but one in Nevada.
Yes.
Right. Okay. And your equity partners, I mean, you think you're going to be doing some more deals with them and a little bit more growth in the partnership?
Yeah, in our joint venture, we have a joint venture with Hunt Realty investors, and in that joint venture, Texas Teachers Retirement invests as well. So we'll continue to grow with our joint venture with Hunt and Texas Teachers, and we also want to do more work together with AEW.
Right. Okay.
So we will continue to grow. We'll continue to acquire within our joint venture, and I expect, with the kind of rapport we've developed with AEW, we'll continue to work closely together.
And you said on this particular transaction, it was all the equity slug, but it was all assumed debt, or did you have to raise any additional debt?
No, what we did in Utah, we're basically assuming all the debt. It was all Fannie Mae debt. One of the buildings has HUD debt on it, which we'll assume as soon as we go through the HUD process. The Nevada building, which we basically bought by ourselves in our own joint venture. We bought that all equity, and we're in the process of putting commercial debt on it right now.
And why'd you do that all equity up front? Are you going to enhance it before you put the debt on it, or are you just going to just want to close it?
In other words, we had to pay off the debt as part of the acquisition, and so we basically didn't want to bring in another lender to complicate the acquisition. So our plan was to finance it and put debt on post-acquisition.
Gotcha. Okay, good. Now, that's a big deal for you to start the year. Do you have anything else like that in the pipeline for the rest of 2014?
Yes, so we have other prospects we're looking at. We're looking at also developing a couple of deals. And as a matter of fact, it's very opportune that we're in South Florida, because we've bought some land in Fort Lauderdale, and we're soon to buy some land in Boca Raton, and we're going to build 2 large buildings in South Florida. We have a major commitment to South Florida, or Florida, between, I don't know if you know this or not, but our management company now manages 75 buildings, and
I knew it was up there. I didn't know it was that high.
Yeah, and we have quite a few. I believe we have 8 in South Florida. So we're really making a major investment in the Southeast.
Well, the Florida housing market is getting better. The Florida economy is getting better. So it's probably not a bad place to be, as long as too many people don't follow you in the new development side.
Well, I think in South Florida, in Boca Raton, and in Fort Lauderdale, it seems like the markets there hasn't been a lot of new product built here, and I think the markets are ready for some new product.
Yeah. Okay, good. Well, good luck, and hope to see you doing some more acquisitions I can talk about with you.
Well,
and the development.
I think we will. Our strategy is to continue to grow and to continue to work with our partners. And thank you very much, Steve.
All right, great. Good to catch up with you.
Thank you.